We talked in Singapore about how to do a sustainable business model for an accelerator. And if you're running a fund and it's an annual fund or triennial fund or whatever, you now have a sustainable business model. You are a venture capital fund. And if you're going to run the angel accelerator in either form or any form like it, you're going to have a fund. Or you're going to have to figure out how all these 40 or 50 or 100 angels can invest directly into each of the companies. And then you're going to charge them a fee for setting this all up for them. And you're really running a fund without the fund structure. So do you want to raise a fund? Big questions come down to, besides, do you want to run an accelerator? Do you want to raise the fund? Or do you want to find someone to raise the fund? Or do you actually not want to raise a fund as much as you're trying to build a community, in which case you may have to help set up a bunch of funds. Maybe this year you do the seed fund, and in 3 years you do the next stage fund, and in 3 years you do the next stage fund to try and build out the whole ecosystem. I came to Seattle in 1992 before pretty much all of this existed. Nothing on this board existed when I was here. Alliance of Angels, maybe. I think Madrona started in 93 or 94.
Alliance of Angels and Puget Sound Venture Club were...
Oh, Puget Sound Venture Club is here. That's right. I didn't get their logo because they don't have a fund. So here's what funds, just a snippet of funds in Seattle. We didn't say it this week. Seattle does not have enough capital for our startups. We're a net importer of capital from California, despite the fact that we have Microsoft and Amazon and Starbucks and a whole bunch of public companies. So even we struggle with this problem. But this is more or less what it looks like. We have a few large full-scale venture funds, 2 of them in tech. Madrona is the biggest. Voyager is a distant second. Madrona's on fund 6 or 7 now.
I thought it was 8.
So they have 8 funds. Every 3 years, they raise a new fund, more or less. Each of them is about $200 or $300 million. They're all 2 and 20 funds. They all last 10 years, in theory. They all invest for 5 years. They're what I would call full-scale venture funds. Voyager's on fund 3 or 4. They got started in '98 because I got the first check from them in one of my startups. So that's the typical fund, and their investors are not angels. Their investors are pension funds, university endowments, super high net worth individuals. And if you wanted to be in their fund, they don't want you in anymore. They're happy with their investors. The next level down also doesn't want you. They're what I would call evergreen family funds. So Trilogy Equity Partners is 6 guys who made money together with a mobile phone company or 2, headed up by a billionaire. So he and his friends invest. It looks like a venture fund. It's run just like a venture fund, but it's just 6 guys' money. Bezos Expositions is just 1 guy's money. It's Jeff Bezos. It's his fund money on the side in a form where he has people who look like general partners, but they're just paid employees. Same with Laird Norton. That's the Weyerhaeuser family. They have a pile of money that they invest in startups. And it's evergreen, as in it doesn't have a timeline. It's kind of like a giant angel. They invest whenever they feel like it. Whenever they get returns, they just put it back in the fund. Nobody on this list actually needs any money. So they just do mostly for the fun of it and to grow the size of their asset base. Then the next level down are mostly new. Founders Co-op is now 8, 9 years old. The rest of them are brand new. In fact, that's the Sea Change Fund that came out of Seattle Angel Conference. Flying Fish Fund came out of the Seattle Angel Conference. There's at least one more that somebody just emailed me that's coming out.
Grubstakes.
Some of the angels in town are starting these as well. They tend to start out really small. Founders Co-op first fund was $2.5 million, which for Seattle, small compared to $300 million at Madrona. Flying Fish is like 10, if I remember that right.
No, they're 27.
27 now, awesome. And so these little seed funds are popping up. They're acting like big angels. Like how they act in the community is like a big angel, but they are run with other people's money like a venture capital fund. So they're doing earlier stage investment than Madrona and Voyager. And kind of alongside them are what we'd call sidecar funds. So we have a whole bunch of angel groups in Seattle, more than we need, or more than we should have, I should say. And most of them have a fund or 2 that they operate inside their angel group. So Alliance of Angels has 2, E8 Angels has 1. And what this will do is write another $25,000 or $50,000 check to companies that the angels inside the group like. Or in the case of E8, they actually let non-members come into their fund. So they run a little $1 million, $2 million fund. Again, mostly $25,000 checks. 40, 50 angels, create a little pool of $1 million, spend it for 2 years. And that's a technique that helps to get to the 20 investments. So if you are a millionaire and you hand $25,000 to Sea Change, Flying Fish, or E8's fund, or probably 50 or 100 to Founders Co-op, they will take that money, pool it together, and they'll make 10 or 15 investments, right? 6 to 15 investments, which means in 3 or 4 or 5 years, you now have 20-something investments. So you're done. You have that fund. And if you do it with a group like Flying Fish or Founders Co-op, you don't have to make any decisions. So you get the fun of angel investing without any of the work of angel investing. And they'll tell you about these companies, and those companies will be happy to talk to you as if you were a direct investor. But in fact, you get to do this with a whole lot less work. And I say this, it sounds a little cheeky. Half of the investors I talk to trying to get money into my fund have no desire whatsoever to be an angel investor and make direct deals. And half the people I want in my fund don't want to be in the fund because they only want to make direct deals. They want to make all the decisions themselves. So it's split more or less 50-50, maybe it's 60-40 one way or the other, on rich people who want control and rich people who want the fund without the control.